Hedge funds are doing anything but hedging lately. In fact, risk management large speculators do. Their recent actions have caused great turbulence in the global financial markets. We'll explore the fallout from hedge funds and much more on today's edition of Inside Opinion. Well, some of the pressure building on the financial markets is being driven reportedly by selling from hedge fund managers. Until recently, hedge fund activity centered around legendary traders such as George Soros, Julian Robertson, and Michael Steinhart. While this group still controls about 15% of the hedge fund market, there are now at least 1,200 hedge funds, up from 800 in 1992. And in the last year, dollars in hedge funds have doubled to more than $75 billion. However, these funds are unregulated, and no one knows exactly how much they're leveraged. Joining us now from our Midtown Manhattan Bureau to discuss the growth of the hedge fund industry is Lee Hennessee. She is director of the Hedge Fund Select Group at Republic New York Securities. Lee, thanks for being with us today.
Nice to be here. If
you could just quantify for us how big the hedge fund industry is in terms of its leverage. If indeed there's $75 billion under management, how much do hedge fund managers then control?
Well, the $75 billion in assets, obviously each manager has his own different way that he uses leverage, and I don't think that I could quantify and make a broad statement like that. You have to look at each hedge fund individually, and as you mentioned, a lot of the attention has been with the three, as you'd say, granddaddies of the industry, but our work shows that there's some, there are just hundreds and hundreds of other managers who each handle leverage and risk in a different way, depending on their expertise in the strategies and markets that they participate in.
What is a hedge fund exactly? I mean, we talk about them frequently, and certainly the name belies what they do. Hedges are normally risk management tools. It doesn't seem like that's what these people are engaging in.
Well, once again, you're focusing on the granddaddies who have a great deal of money under management, and who the clients that invest in the granddaddies understand that you don't achieve 50% type returns without the potential for some volatility on the downside. But the focus that I think is an interesting and important one are the hundreds and hundreds of other hedge funds who really are in a format which is typically a limited partnership for U.S. investors that allows for flexibility. We like to use two terms to sum it up. One is incentive and one is efficiency. The efficiency affords the use of many, many different strategies, and once again, each hedge fund manager chooses the strategies that he's most comfortable with. There are many, many degrees of risk. One of the groups of hedge funds that I think you won't hear a lot of negative news about, particularly this month, are the group that we categorize as what we just call growth managers. This is the dominant theme. These are managers who basically are focusing on the U.S. markets. Their dominant theme is picking growth stocks, but on the long and on the short side. And for instance, our work in the indexes that our proprietary indexes, measuring peer managers in this growth category last month, the month of January, when the market was up, the S&P was up almost 3%. These managers only came in with a 1.5% return. In February, where we're finding that the market, the S&P is maybe negative, a little less than 3%, as we're talking to these managers who are obviously underperforming last month because they were positioned on the short side. And we're finding that this month that hedging is presenting positive to flat returns. So these techniques work. Each manager has his own strategy. And the ones that I'm mentioning, these growth managers that are dealing in the most liquid markets, the most regulated markets, the markets that are the easiest to short in, are coming in with good returns this month.
And yet these are not, as you say, the granddaddies. When those headline-grabbing names come up, they are not necessarily engaged in equity strategies, but instead engaging in complex currency and interest rate trades worldwide. Since they do generate the headlines, do they also represent the buying and selling power, or the majority of the buying and selling power out there in the hedge fund world?
Well, you're correct in that statement, but I would remind you that you mentioned Julian Robertson before, and as a equity salesperson going back 19 years ago, understanding Julian Robertson as a salesperson is something that, you know, he's a stock picker. His orientation is towards being a good value-oriented stock picker. Each of the ones you mentioned, George Soros' history was, you know, his dominant theme originally going back 30 years ago was as a currency trader. So I think you have to look at each hedge fund individually. And yes, you know, there's been a lot of news in the media. There's the central banks are, you know, rightly so, trying to study and understand risk. But the study and understanding of risk is always good. You know, so and one thing I would, you know, say in regards to the granddaddies, who, you know, of course, I have a great deal of respect for, and have been fortunate to know each one. You know, these fellows will be very quick to act and to react. And yes, there's a lot of turbulence in the markets. Markets, you know, bring turbulence, and the turbulence, when acted upon correctly, can bring profits. So I would, you know, very much expect them to regroup, refigure, redefine risk. And our questions to them in our next meetings will be, what did you learn from this last debacle? What are you going to do differently next time? And yes, there's been 4 great years of fabulous returns that maybe there's a little bit of overconfidence in the, as you'd say, directional betting. But I would certainly take my hat off to, you know, George with 30 years and Michael Steinhart with more than 20, and, you know, Julian Robertson with his more than 12 as a hedge fund. But even with, you know, with Julian and other hedge fund managers, these are not individuals who you don't know where they came from and you're not sure where they're going to go. Julian at Webster Management was head of, you know, research and managed investment management division. Most of the best hedge fund managers that, you know, we feel the most comfortable with are individuals that ran top mutual funds, we're working with one of the 22,000 registered investment advisory firms. You know, I mentioned before this point of efficiency and incentive. Hedge funds are, in my opinion, very much here to stay. There are 22,000 registered investment advisors or more. These managers, to them, you know, risk is raising cash and not beating the S&P.
Lee, I have to stop there because we have to take a commercial. I appreciate your spending the time with us today. Lee Hennessee is the director of the Hedge Fund Select Group at Republic New York Securities, joining us from Midtown Manhattan.